find the value opportunity based on that cap curve also. So that one thing is the market gives us crisis creates value opportunity, and among the crisis also the cap curve creates a value opportunity. Market becomes cheaper at that point of time. Then the second important from where we can get a value opportunity is sectors, right? So temporary challenges like raw material shortage, disruptive regulation, some chip issues, some kind of demand problem in a quarter or 6 months kind of thing in any of the sector can create some kind of sector. That sector is trading discount to their intrinsic value. So the current example may be your IT was trading at your IT is trading at a discount to the long-term intrinsic valuation due to some kind of issues in the demand, right? And some global meltdown has happened in the IT information technology sector, and this sector in India is trading at a discount to its long-term intrinsic value. Similarly, other sectors in the past has also been there when there is an issue in that sector for a short term, but overreaction by the market participant has given us a opportunity and intrinsic value, if you look at, which was higher compared to the price at which they were trading. So during that, sectors up move and down move can give the temporary challenges on any of the raw material, temporary challenges in any of the other regulation provides the opportunity to pick the value stocks. Third and important is a stock specific. There are some short-term issues in the stock specific. Some companies may be finding some logistic challenge to get that raw material, or there is some kind of demand destruction or some kind of delay in delivery has happened, and that creates a value opportunity. Apart from that, there is an unlocking value also available with the restructuring, merger and acquisition. The spin-off happens, say some companies getting de-merged, say some companies acquiring some business from other company. All this reorganization can create a value unlocking opportunities. Apart from that, if some management has changed in some company and that management has a complete different focus and the growth focus with the distribution focus and all compared to the previous management, at that point of time is the value opportunity is getting created or not. So in a nutshell, the value, what is value? Simple terms, the intrinsic value should be more than the price. And from where we get the value opportunities? Market cycles, sector cycles, and stock cycles provide us the enough value opportunities in the market. So these are the two ways to look at the value and value opportunity. Now, understanding the theoretical part, now let us assume some kind of real life cases, right? So real life case studies, if I look at, first of all, in terms of sector, right? So first, information technology. In the last 20 years, we have seen 5 cycles. And every cycle, the stock, the sector has been trading at the lower than their average valuation. So if you look at, average valuation is somewhere around 20-21 times in last 10 years, median PE, what I'm talking about. And the PE of the sector in last 5 cycle has gone down, and then sharp move we have seen in the last 5 cycles. Just to give an example of cycle 4, right? In cycle 4, there was a kind of issue in the information technology sector that the changes in the product which is happening, the Indian IT companies may not be able to, go through that kind of changes. And the sectoral PE was much below than the average PE, right? And after that, if you see that there was some value opportunity to create, this kind of company was kind of company which was a growth company. They adjusted themselves, and when the return has came, the return come at 78% in cycle 4 as compared to the Nifty 500 TRI of 43%. The latest is the COVID cycle 5. Again, the valuation of IT sector has gone down, and after that the rest is history. IT has given a phenomenal return. So the point where we want to speak here is that the cycle in any of the sectors gives us an opportunity to find the value stocks. And when the sector bounced back, it has delivered better returns than Nifty 500 index every time from cycle 1 to cycle 5. right? So now going to other live example of BFSI. So if you look at the BFSI, in the last 10 years, we have seen a many cycle, and most important is your asset quality cycle, specifically for the PSB banks, specifically for the public sector bank. We have seen the last 10 years, there was a lot of, kind of NPA was there. The credit cost was eating up their profitability, and the ROE was very low. Some of the bank have reported losses also, right? And based on that expectation, in 3 cycles, this has traded their long-term average. They have traded much below than their long-term weighted average valuation. So, median PE was somewhere around less than 1, and they were trading at 0.5, 0.6 kind of. But every time, if you look at that cycle, if you find that cycle, and the return was much higher in every cycle compared to 500 TRA. Again, the latest being COVID, and before that demonetization, that is April 16. Sorry, before that there was a kind of Jandan on April 16, and before that also there was some April 13, 14, the asset quality cycle and all. So what I'm trying to say here is, in cycles when there is some kind of earning disruption, generally market tends to react more, and at that point of time in sectors we can get a better value opportunities, and the returns are in front of you. The cycle 1 return of Nifty PSU TRI is around 108% compared to Nifty 500 is 51%, and similarly with cycle 2 and cycle 3. Creates a potential attractive investment opportunity when there is an overreaction by the market in any of the sectors, and this cycle keeps on, right? So these are the two ways where the sector wise value opportunities can be find out, and there are many examples of it, and we can provide as many as sectors kind of example where the last 10 to 15 years has always given us a value opportunity kind of. Moving towards the third area, right, that is a stock specific. What I have said is the short term issues, right? There is some kind of demand problem, or some company specific raw material problem, or company specific logistic problem, and because of that, again, a market has overreacted, and that stock is trading at a discount to their intrinsic value. That is one way to look at the value. Another way in a same kind of bottom up approach is merger and acquisition. Merger and acquisition, company split, demerger can provide us another value opportunity. So, just giving an example of one company, right? Before acquisition, right? This is a pharma company that was very operative, but it was operating in a very lucrative segment, right? The demand for that product was very high, and management was very happy with the average business and average business growth, and they knew that there is a demand for that product, but they were not able to capitalize on the full potential of their product, right? And consequently, the stock has underperformed compared to its peers, and the valuation of that stock was lower than the industry valuation from FY15 to FY20. Then in FY20, right, that company has got sold to a PE investor. That PE investor has brought a MNC management, and the company become aggressive and focused on both organic and inorganic growth opportunities. Then they focused on their distribution channel. Then they focused on the new attractive segment. Then they acquired some of the smaller size business, and now and created a bigger size business kind of thing. And the full potential of its well-established brand, they had started to focus on that. This stock now significantly re-rated and is now the best performing stock in the pharma sector. The current valuation of this stock is much higher compared to the pharma valuation. So, again, the example which I am giving you, after the sector, after the market, that stock specific, there is also opportunity comes in a cycle to find a good value opportunity. And this company is a live example. And the performance of this company post the acquisition of the PE is phenomenal. So just to give you the company's return, right? So if you look at what I have told, from March 15 to March 20, the valuation of this company was 16.8 and 14.9, right? and Nifty Pharma Index valuation was much higher than the company valuation. And after the change in the management, after the focus in the business, after the focus on the brand leveraging, after the new distribution channel, new product, you see the valuation has zoomed to 31.6 as compared to the NSE Pharma Index of 29.5. And you look at the performance, right? So these are we call the value unlocking. Till March 22 till date, the company has given a 288% of return as compared to the pharma index of 115%, sorry, 67%, and NSE 500 index of 115%. So much higher than both NSE 500 and pharma company, both in and NSE pharma index. So this is the value of value. This is the finding an opportunity in value, finding an opportunity in unlocking M&A, restructuring, business acquisition, and all. This is the third part where we can get a value opportunity, right? So, first we have understood that what is value, then we have understood from where we will get a value opportunity, and we have seen some real life examples. Now, again, the most important part of this, kind of investment thesis and our investment thought is what is not value investing, right? So, like there is a very thin line of gap between the value investing and value traps, right? So first understand what are value traps, right? So value traps are those where we will see that, okay, this stock or this company is trading at a discount to its peers, or trading at a discount to its average 5-year valuation or average 10-year valuation. So it has become a kind of value. They may have a poor fundamentals, they may not have a poor fundamentals, maybe the cash flow very high, but overall poor fundamental means that the growth trajectory of those company is not as per the industry or lower than the industry. So this will remain a value trap. So what I'm trying to say is that looking at only one parameter, like trading at a discount to peers or trading at a discount to industry and low PE, right? And the poor fundamental means the growth prospect is not very high. That is a value trap, right? So how to avoid value trap? Do not use only one metric, like only PE or only one valuation ratio. You have to do the due diligence of the fundamentals to find out the true potential growth opportunity for that company. And if you look at the industry, who will appear cheap because of their cyclical nature, and among the industry, the growth is lower in that company, then this is a value trap. You have to go with the management, you have to listen to the management, and you have to find that this management is a very sound management, and in the future, the growth of this company can be very high growth. Or if the growth is very low or the lower than industry, then it is a value trap. So in a nutshell, what I'm trying to say here is value with growth is fine, but value without growth is a value trap. The company should have a growth which is higher than the industry, higher than the peers, then it is a value. If the growth of that company is lower than the peers or lower than the industry, or industry growth is declining, lower than the nominal GDP growth of the India, then it is a value trap kind of. So now, just to find out the case of study of a low PE stock, which is again a value trap kind of, right? So we all know this company, and this is a company which this is the oil sector, lubricant, automotive lubricant industry, right? And way back in 2015, it used to trade at 42 times kind of, right? And grown at a pace which is slower than the India GDP growth over last 10 years. Correct. The company is not able to change its product mix. The company is not able to change its delivery pattern. Entire industry has changed in terms of better engines, in terms of the electrical vehicle and all, but the company is not able to change themselves. And you look, the stock was cheap at around 22 times also, the stock was cheap at around 17 times also, and the stock is currently at 12 times, still it is looking at a cheap. But if the growth is there, the growth is lower than the GDP growth over the last 10 years. And the stock has performed, is up only by 0.6% as compared to Nifty 500 index of 15%. So this is a value trap. It's a clear case of value trap, right? So this is the case of value trap, right? Now, hope I'm clear in terms of, again, the second case of, low P, high P and value, non-value kind of, right? So now in terms of metal industry. So metal industry generally works in a cycle, and metal stock prices moves in line with the commodity prices, right? The steel prices or aluminum prices, the commodity prices, metal and oil and gas are highly dependent on the underlying commodity price. So during the peak of commodity prices, right, when your metal prices or oil and gas or Brent is very high, this company's PE will look very low, right? Because you have factored all the earnings and all these things, and the PE will look low. But these stocks follow the commodity prices, commodity cycle. So during the peak of the commodity, the PE of metal or the PE of oil and gas companies will always look low. But is it a value investing? No. And during the bottom of the commodity cycle, the PE of the metal company will always look high because you are not factoring a higher earning growth, right? So the point which I am trying to make here is that only one parameter, don't judge the company with only one parameter, and each and every sector has a different parameter to judge the fundamentals, judge the value of that company. Here is the case of the example. If you look at the cycle one, right? In cycle one, if you look at the prices of domestic HRC were falling, and kind of Nifty P was somewhere around, so Nifty P was somewhere around 10-11 times, and in the cycle one it has given a negative return compared to the Nifty 500. So the point which I'm trying to make here is that the metal industry is a classic example that it will have a high PE when the commodity prices was very low, but at that point of time, it is commodity prices is low and the stock may perform well, and the PE would look very low when the commodity prices will. So this is a classic example that don't look any sector, any stock with a single multiple or single valuation. You have to look with the different kind of valuation parameter. You have to benchmark the growth. You have to look for the industry growth. Then you can find the intrinsic value. Otherwise, it would be a value trap, right? So the point is the value, how we find a value, and the important part is the value trap. Now, after understanding, what is value trap, what is value. Now, just to give you an example with our thought process and all, if we find the Nifty 50 value TRI index has given a last 10-year CAGR of 16% return compared to Nifty 50 TRI is a 13% outperformance of 3%, and the 12 out of 14 financial years, the value style of investing has outperformed the broader market benchmark. Now to sum it up, value investing, as I explained, is an investing in a stock which are at discounts to its intrinsic price or true potential. And how we will find a value opportunity, I explained it. The three labels are there. Market provides us, in the market, cap curve, then the sector is specific, whether it is an IT, BFSI and all, the example which I have given you, and the stock level, either bottom-up approach and the restructuring or M&A and all this. Then the most important point, beware of value trap. Low PE doesn't translate to a value stock. And then the fourth, our research-based stock picking and professional management is there in terms of we have a 11 people team in terms of identifying the value of it. So to understand about our thought process of value and what we are calling as value, now I introduce the value fund. And about the fund, the fund is aimed to invest in a company that is which aims to generate wealth in the long term, 3 to 5 year kind of horizon, and they evaluates the parameter like present value of discounted projected cash flow, PE, PB, EBITDA, earning potential. Your growth should be higher than the industry growth or peers growth, value unlocking opportunities. All this parameter will fit, and we will find the companies, we'll find the aims to look for companies with a strong fundamental across the market cap and sectors without any bias in each either, right? And how to find that stock. So I'll explain it in our later slide. And how we define value, which I explained you, the iceberg approach. The iceberg approach is the tip of the iceberg is only showing a valuation is low, or a P is low, but the bottom, the bottom of the pyramid, the bottom of the iceberg, which is 3/4 part of the iceberg, which provides us the all the kind of market cycle, business cycle, company specific factor, mergers, demergers, acquisition, to find out the true value, true intrinsic value of the stock. Now, our investment philosophy, how we find investment, how we kind of what is our comfort factor. So we work on 3S framework. The 3S framework is largely a margin of safety in balance sheet, margin of safety of earnings, and margin of safety in valuation. When we say a margin of safety in balance sheet, that means balance sheet should be sound, low leverage, cash flow should be there, right? And obviously, related party transaction disclosure should be well aware of. Second is margin of safety of earnings. We should be confident of the earning trajectory of the company in next 3 to 5 years, right? And obviously, margin of safety in valuation. We are not we are saying the GARP principle, that is growth at reasonable price. Growth at any price, any valuation is not accepted. There should be a margin of safety in the valuation. How we construct our portfolio, how we look at the investment philosophy, create our universe, come out with the value stock and avoid the value trap is, first we run the screener to scan the investable universe to determine company with the strong financials, fundamentals and all. And we do a top-down and bottom-up approach to pick up the sector, right? And in sector, top-down approach means growth, industry growth should be higher than the GDP growth, and the bottom-up approach should be the valuation, earning potential, which I explained that there should be a confidence of the earning. The second is identifying undervalued companies using the most suitable valuation technique. And the third, the most important, is red flag on value traps. So we have a decent number of people. We are 11 people team to find out to do the screener, to find out the value traps, to find out the value stock and now. And then we construct a portfolio considering the opportunity size and risk limits. What is the major advantage in investing in value fund? First of all, the catching the potential gem. So which I explained you in the market cycle, that market provides us opportunity in every cycle to find out our potential gems, as we are buying much lesser than their true intrinsic value. Then in that we can also find the cap curve, right? The stock which we will find in the value opportunity would be a less volatile, involves buying long-term stocks which tends to be less volatile. The value investing involves selecting stocks and stay invested in 3 to 5 year horizon, long-term horizon, right? Because it's a value investing and we are finding out a cycle, and we are finding the value opportunities in that cycle. And obviously this kind of investing style always leverage on the market sentiment. Market tend to move according to investor emotion, like greed and fear, right? When there is a fear factor, we get it at a very high discount, right? And in the greed factor, we know there is a lot of optimism built on the price, and this creates opportunity for the research-based rational value fund manager. Then who should invest in this? Long-term investor with a horizon of more than 3 years should invest in this. And who wants to diversify their investment portfolio, who should invest in this? And the fund aims to look for the potential earning growth as well as the valuation relating. So these are some of the fund facts. Mr. Shiv Chanani will manage our fund. He is currently managing the mid cap and consumption fund. And this fund would be run like a flexi cap fund. And at any point of time, it would be around 50 to 60 kind of stocks, not more than that. So yeah, so this is from my side, and hope I am able to understand hope I am able to make you understand our thought process of value investing, and what we think about the value fund and how we will run this value fund, how we select the stock, how we select the universe. Now I'm happy to take any question. Floor is open. Any questions?